Welcome back to another Fed meeting. Today we are expecting a 25 basis point cut from the Federal Reserve. And, well, after that 25 basis point cut, the rest is probably just going to get blown off. I think we're going to get a Powell here that's pretty straightforward and saying, hey, I don't really know what's going on, so we'll just take it one step at a time. Here's a 25 beep pizzle, and that's it. I don't know that we'll really get much from Powell on employment or inflation. I know markets are kind of looking for the Fed to do some research for them and kind of tell them, like, hey, man, is everything still good? Is the economy still fine? We good? And I get it. It's a lot easier to just listen to Powell and go, hey, man, you think everything's good? If you think everything's good, I think everything's good. I do think there are some longer-term risks with that. Longer-term risks include the Federal Reserve potentially wanting to say everything is good to keep everything good in the face of things actually going poorly. Keep in mind, financial conditions since the last Fed meeting, and this is what's going to be very interesting, since the last Fed meeting, financial conditions have tightened substantially. I mean, you're 70 basis point tighter since they cut 50. So consider that for a moment. The Federal Reserve, with the September meeting, cutting 50, and this meeting, cutting another 25, basically loosened financial conditions by 75 basis points. But markets tightened them by 70. So in other words, the Fed did nothing. Markets instead tightened financial conditions, and they made things worse. So the Fed's trying to accommodate the jobs market, but the market's like, nah, that's just going to cause inflation. Screw that. And raises rates. Partly because of anticipation of a Jerome Powell or of a Donald Trump win. That's okay. That's understandable to price in. But it is something that we're going to have to deal with in terms of how do we reconcile that as a Fed, is something they're going to be talking about, and they're going to be expected to answer. Like, if I were in that press conference room today, I'd be asking, hey, Fed, what do you, like, you're cutting rates because you want to support the jobs market and you seek no further cooling, but the actual financial markets are saying, we don't trust you, and we're going to tighten financial conditions. So that's probably the big question going in. In fact, I'm going to write that down just so we have that written down. Big question going in. You seek no further cooling in the labor market, yet as you cut rates to support the labor market rates shot up 70 BP. What say you? That's going to be the big one. All right, so we'll see. We'll get the Fed decision in about 45 seconds. Make sure, if you haven't yet already, signed up for the free morning alpha alert on some trade ideas and trends and support and resistance lines to pay attention to. Make sure you do that by going over to meetkevin.com/alpha. If you're international, hit the little button below it, below that little yellow button. But if you're in the U.S., just hit that yellow button. And get your text and your email with the Alpha Report every day. Okay, here we go. So I'm going to pull up the Qs just so we have that. And the decision is we're looking for 25 bips, and we get 25 basis points. 25 basis points it is, and the statement says inflation has made progress to 2%. Let's see here. Progress to 2%, but remains somewhat elevated. Okay, that's good. Fed omits reference to having gained greater confidence in inflation moving to 2%. Oh, that's interesting. Okay. Let's see here. We got our quarter point cut. Judges employment risks and inflation. Employment, inflation risks as roughly in balance. Labor market conditions have, quote, generally eased. Economic activity continued to expand. Economic activity continues to expand at a solid pace. Will continue to reduce its bond holdings, so we're still doing QT. QT continues. And unanimous 25 BP cut. Oh, that's interesting. Unanimous 25 basis point. All right, interesting. I was expecting, maybe a little bit of dissension there. I'll get the statement in a moment, but let's listen in here for a moment.
That is it. I would say a waveless or splashless quarter point post-election cut.
Well, it's a bit early, but you're probably right. Steve, stick around. Let's turn to our panel for some more reaction. And of course...
Yeah. I mean, that's a good way to put it. Waveless or splashless. I mean, it's basically a way of saying, hey, we're just going to kind of stay the course and do the 25 BPs. This makes sense. I mean, this is what was expected. So far, everything along expectations. In my alpha report this morning, I mentioned that I did not think that the Federal Reserve was going to make a big difference this morning. Certainly not on the widely expected 25 BP, but you would just want, a cautious Powell, respond to the balance of risks, and basically not really give us any kind of real forecast. That was in this morning's. I also talked about this morning in that alpha report that I hadn't seen profit-taking really enter this market yet, which I kind of think you need for markets to go down. You need profit-taking, and you're just not really seeing that, and that's in part because prices keep going up, right? So, why take profits if things keep going up? Recent indicators suggest economic activity has continued to expand at a solid pace. We had already read out some parts of this. Economic outlook is uncertain. They're attentive to risks on both sides. They did get rid of the statement, so again, removed statement of greater confidence. So they sort of just removed that that phraseology. Now they're just talking about the balance. Carefully assess the incoming data, the evolving outlook, the balance of risks. There's that phrase. Going to keep going. Focus on the 2% target, blah, blah, blah. None of this is unanticipated and then unanimous. So this is it's almost like they simplified the statement a little bit. Markets kind of not really doing anything here, it doesn't appear. You've got, markets relatively stable with where they've been sitting before the meeting. So we'll keep a watchful eye on there. But let's see here. Let's go to bond markets not really moving either, even though they removed that reference. I got a couple spelling errors here. Reference to having gained greater confidence. I don't think, I'm going to make a note on that this is likely because the Fed wants markets to focus more on jobs rather than on fear that inflation is rebounding. Progress to 2%. Inflation has made progress towards the 2% objective, but remains somewhat elevated. It continues to see blah, 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 blah. Yeah, okay. Yeah, that was my sort of read on that, but let me see what some suits are saying. Treasury yield still down by about 8 bips. Rebound from yesterday. Market's relatively stable. Conditions have generally eased. Stocks aren't doing much. No, nothing here. Currency markets, steady. Now, it's all going to come down to the commentary. This was the anticipation. And so really, I think now for commentary, some things that we want to think of, there are really two ways to go. Commentary, two options. Okay, so we're going to call it option number 1, and then we're going to call it option number 2. Option number 1 is everything is fine, and then things are okay is option number 2, we'll call it. Here, we'll write it together. Give me a sec. We'll do this together. Okay, stand by. Okay, and this is going to be sort of how I'm thinking about trading it as well. Okay, there we go. Okay, commentary, 2 options for Powell. And we'll put our little opinion hat there. There we go. Number 1, everything is fine. Number 2, things are okay, but worsening. All right, so everything is fine. This is going to be economy is doing fine. Job market historically, or I should say unemployment rate historically low. Inflation is trending towards 2%, with housing disinflation still working its way through. Let's see here. Uncertain, it won't make prediction on politics or a political impact. We'll take things as the data comes. I think he'll say that no matter what, so I'll put that on both of them. But this one we're gonna go with, we want to support the labor market, and then I think you might go with the angle of last 3-month labor market has weakened substantially. This would be dovish, right? 2 options. I'm going to say predictions. Prediction 1, just to make it clear, this is a prediction, not what's being said. Okay. We want to support the labor market, and yields up while trying to support the labor market is not useful. Last 3-month labor market has weakened substantially. This would be dovish. This would be dovish. And think we can without causing inflation. Dovish, right? Economy is doing fine. This would be hawk. Unemployment rate historically low. This would be hawk. Inflation is trending towards 2%. This would be neutral. Impact. Spell things correctly here. There we go. Okay. So that's a little bit of what I have on my prediction sheet. Now what we could do, we'll put this, we'll go ahead and put it on a bingo card too. That's not a bad idea. I do see end phase popping a little bit. It was down about 3.5% there, and the Qs are moving up slightly as well. End phase had a little bit of lag there. Tesla's over the 295 level, which is huge. It's gotten rejected a few times now near 300. 300 is a really big psychological threshold for Tesla. And so breaking that could be a game changer for the stock, which is good. You know, barring obviously a recession. I mean, everything is barring a recession, because if you have a recession, everything's kind of screwed. But, okay, paying attention to the cues here. At the same time, I'm going to now make a bingo card. What say you we should put on the bingo card? Yes. Okay, let's see here. Da-da-da-da-da. Oh, how do you go to favorites? Oh, there we go, favorites. Aha! Aha! All right. Fed bingo card. Take a peek at this. We actually have a bingo card. So we'll make a hawkish column. So I'll call this the hawk column. You know, I'll label it below. This will be the hawk column, and this will be the dove column. And then we'll go with Powell shows up. How about we do, over here we'll do Nick T and NYT girl back together. Then we got to do purple tie. And then we're going to go with some non-Apple laptop for notes. And then we go for politics. I think either way, we're just going to go won't pre-decide political impact. will wait for the data and react or respond to incoming data, not political assumptions. I think that would be a pretty reasonable phraseology there. Okay, let's make that a little bigger so y'all can see that. There we go. Okay, unemployment rate historically low. That's going to be the hawk column. Unemployment rate historically low. Okay, then we'll do economy is fine. How about housing disinflation still to come? Then we want to support labor market. Some form of clear indication of support for labor would be very interesting. Responds to higher yields. Yields as hurting Fed work. Neutral rate might be much higher than expected. This would be very hawkish. Blames productivity for higher neutral rate. It's an option. Then let's see here. 3-month talks about the 3-month average of labor weakening. Okay, over here we could say blows off 12K October labor report with hurricane and Boeing comments. Then how about this? He gets asked, are you going to quit under Trump? Bonus. He says no. That'll be the question. All right, let's see. Let's see what other ones you have. Noisy data. Yeah, I like that. That's a good one. So we'll do says data is noisy, noise or noise in data, and won't respond to a single report, rather a trend. Okay. Let's see here. Recession according to New York Fed at 56. Yes, exactly. I don't know if he's going to get asked about recession, but I'll write that down. That's for what you're referring to is the New York Fed's Treasuries, sort of the they look at the spreads of interest rates and they try to predict that as a tell of recession. Recession odds at 57%. Some and that's for September 2025. Any comment on recession? Bonus, no recession now. Right? Okay. Red tie for bullishness. Shut the effing door. That's funny. Bingo card. We do not comment on elections. I like that. No comment. No comment on election. Let's see here. Blow off the top until January? Maybe. Dollar strength. Oh, tariffs. Oh, he gets asked about tariffs. That would be a good one. So let's do gets asked about Trump tariffs and punts. Punts, but may suggest, and then we'll go bonus, suggests tariffs affect supply and increase prices, buyers pay. All right. He might say that. So, because sometimes he does that. He'll be like, oh, no, I'm not going to comment on that. But, you know, from an economic point of view, and then he goes to comment about it. Hawk Tua. I'd like, data revisions. Yeah, negative data revisions. Dovish. Any kind of commentary on supporting labor market more than inflation, a tilt of risk, that would be dovish. Let's see here. Economy doing fine, that would be hawk. Okay, something that would be interesting is why unanimous after someone voted no. Was there a weakening noticed? That would be interesting. Definitely going to say data dependent. I'll write it down. Data dependent, but not data point dependent. We'll call that one the bonus. Powell shows up on time. Yeah, that's a good one. Labor market, why are you cutting rates? That's a really good question. Is asked, if labor so strong, why cut rates? That's a good one. All right, that's our bingo card. So here, let me let you all take a screenshot here. Oh dear. How am I gonna pull that off? I don't think I can. I think you're gonna have to take it like that. So go ahead and take your screenshot. Enjoy. And then zoom in. All right, Q's moving up nicely here. Actually, look at that. You're up maybe 10 basis points or so since the letter came out. Super Micro rotated up a little bit. Actually, in the stocks and psych course, I sent an alert today, which you can get that if you want. It's different from the alpha letter, obviously, in the morning. But in the stocks and psych course, I sent an alert when I saw this wedge right here, this converging uptrending wedge. And so I shorted the sucker over here when we broke out, and I closed my short over here. So that was nice. That was a good trade. I thought the entry was really good on that, and I thought the exit was really good on that. So I can't obviously always guarantee every trade is going to make money, but if you want alerts like that, at least then you could look, in the middle of the day and go, oh, okay, yeah, I see that. I see, like it's important for you to analyze the trades too and be like, oh yeah, do I agree or disagree, right? I think that's critically important. So anyway, so check that out over at meetkevin.com if you want. Okay, so Tesla doing decently here. Okay, let me see here. Okay, so somebody says, where's the 10-year going? Yeah, let's find out. 10 right now. You're still down 7.5 basis points on the 10. You got a former Fed person here. Let's listen to this person.
Down as we go into a bout of what looks like pretty serious deficit spending.
So what is the Fed's role when that is the case? No one's saying that, that they need to react to fiscal policy, but in some ways they can't ignore it either.
Well, no, they can't ignore it. So what they'll do is obviously run it through their models. They'll think about it, and they want to see if there's an inflationary impetus that comes from that. And all of that depends very much on whether or not, productivity increases and the economy grows. Uncertain for sure. And so let's wait and see. But I think they will be a little more attuned to pick up an inflationary risk as we find, bigger and bigger deficits and an increase of the debt. But not yet decided, and they'll wait and see.
Yeah, and I wonder if you're pointing to the idea that there might be fiscally stimulative things like tax cuts and spending programs that are in the pipeline.
Yeah, if you want to join the newsletter thinking the Alpha report in the morning, if you're not in the U.S., just press the gray button right under the yellow, and you could join. So the way that works is when you're here, just scroll down right here. It says outside the U.S., click here. You can click that button. So, there you go.
To propose.
Meetkevin.com/alpha or scan that QR code up there.
This is not an immediate thing. And so I think it's first, what is the policy? Then once they get the size and the magnitude, they'll run it through their models of the U.S. economy, which are the best out there. And so I'm not in any sense suggesting that the next move is going to be up. I think they'll wait to see what the policy is, assess it in an analytical sense, and then be prepared to move if it looks as though inflationary pressures are going to pick up.
Yeah, or it could.
And so we shouldn't be on our.
Go ahead, finish. I'm sorry.
Yes, go ahead,
sir.
please.
No, I was going to say, I guess.
No, we shouldn't be.
No, please finish. I'm sorry.
We shouldn't be attuned to a sudden change in policy from either the administration or the Fed. So we're talking about something that's going to play out over quarters, if not years. And so we should just be very mindful of a time frame here that's not the next few meetings.
Yeah, that was kind of what I was driving at, was the idea that this is going to play out over time, the reaction to whatever the fiscal policy is, and it could be that interest rate cuts are slowed, or if there's a strong feeling that the policies are going to be inflationary, well, maybe interest rates go up a tick. But that's down the road under any of the scenarios you can envision.
Yes, it is. I think they're on the path. Inflation seems to be coming down right now. They focused on the labor markets, which are probably okay, but potentially weakening.
You know what's really interesting? Where's that website again that Kevin puts his notes? That's ehack.com. What's really interesting is, so Nick T, in fact, I'll show it to you right here because we're going to get it together. So this is an interesting Nick T piece, and this could actually preview what the Fed might say here. So watch this. So Nick Thiermo, I'll just put Nick T. Wall Street Journal, immediate post after cut. Let's see what he says. So I think it's interesting that he's talking about this. Since Fed cut, longer dated bond yields have climbed notably, meaning the cost to borrow for a mortgage or car has gone up. Yields have increased in part because of better economic data, but some analysts' concerns about higher inflation or Trump. Yields up notably, cost to borrow up therefore. Either way, market has generated an unusual result. Borrowing costs rose after the Fed cut. Yeah. Okay. Yeah. Markets have also, this is actually, we talked about this morning. In fact, I talked about it right here. See right here? How I talk about the Fed projecting, what's it called? Fed projected cutting rates to 2.9 by the end of 2026, and markets think we'll only go to 3.5 by the end of 2026. Previously markets thought we would cut all the way down. I should write. I'll note that in here. In September, markets thought we'd get to 2.8-ish by end of 2025. So that's a big shift. So here, Nick T also picks up on market divergence, which is Fed wants to cut to 2.9% by end of 2026, but market only sees 3.6%. Officials are trying to bring rates back to a more normal or neutral setting, but they don't know what constitutes normal. This means they would hold rates somewhat higher than a normal or neutral level. Before the financial crisis, many thought the neutral rate might be around 4%, but after, they thought it was closer to 2%. That's an interesting comparison. So before 2008, neutral rate, and Powell speaks in about 5 minutes, thought to be 4%. After 2008, neutral rate thought to be 2%. Where is it now? Okay. Potentially get to 3.5% next year. That's what they've already projected. because officials don't have much conviction as to where neutral sits, they're likely to be guided by how the economy performs. Exactly. They're going to be data dependent. No idea, so they'll watch the economy. If inflation keeps slowing and the demand for workers looks soft, they might continue cutting along the path from September. If, this makes sense. Inflation soft and labor soft, they may keep cutting. If stalls, let's see here. Officials may not keep cutting. That would be hawkish, right? Most immediate focus is whether they'll cut again in December. The challenge is how do they signal December? Right. Okay. Question now is what comes for December? The election result raised the markets to new high, could present a case for risk management to potentially skip that meeting. Well, yeah, but yields also went up, so you have a little bit of a struggle there, you know. Stocks high loosens financial conditions. Bond yields up tightens conditions. So you have a little bit of a, both sides of the equation there. So anyway, okay, so the meeting's supposed to start in about 3 minutes. Let's listen in here for a moment.
When maybe the stakes go up a little bit from here, but they're following, the path that they've mapped out before in terms of normalizing rates. I get a lot of the back and forth about what to make of the yield move on the long end of the curve, and
Yeah.
Do you think that it means a policy mistake? Do you think that it means there's a deficit, tantrum going on? I don't really see there being that much to explain. July 31st, we were right at this level at 4.25 on the 10-year. We had a massive growth scare that collapsed yields. The growth scare went away. We got a rate cut that's in part supposed to be helping to normalize the level of Fed funds as well as the yield curve. That seems to be what's going on. Maybe if we fly from here in yield, that's going to tell us a different story besides just, hey, we're still in an economically resilient time and the Fed can deliberately adjust policy on the short.
For December, by the way, 63.7% chance of a cut going into the meeting.
A market with a much bigger reaction, even if that's not what they're hoping.
Yeah, I think, if somehow Powell gets very explicit about, a December pause, or maybe we're closer to neutral than we thought we were, I doubt that's going to be the case. He loves to be very agnostic vocally about, where.
Dude, there's no way Powell is not comparing. This is just Kevin's opinion, okay? There's no way he's not comparing this to 2007 when everybody's like, yay, soft landing achieved. This is the best economy in the world. Nothing can go wrong. Everything's great. And then, March of 2008, you're in a recession. It literally did not take long for you to end up in a recession. So, that could happen again. And I think it would be prudent to be cautious of that. Anyway, I just got some House Hack DocuSigns, by the way, so if you're still interested in investing in House Hack, that offering is still open. You get a 5% yield right now, plus upside in the stock. Read the details over at househack.com. And also keep in mind that you can get my free alpha report in the morning. It actually takes quite a while to put together. It takes longer to put together than I thought, but anyway, I enjoy doing it. And that goes out at about 6:15 in the morning, text and email. And sign up for that over at meetkevin.com/alpha. Okay, so with that said, let's get this show on the road here. Should be seeing Powell any second now. It is now 11:30. Okay, just waiting for him to show up, basically. Come on. Where is he? He's always on time. Yeah, two investors just signed for House Hack. So I was just looking at those DocuSigns. So more. Oh, there he is. There he comes. All right, let's get him over here. He's on time.
Good afternoon.
Purple tie and not a Mac computer.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms.
This is hawkish so far.
It is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer-run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the
straightforward.
expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Somebody's like, it seems like the questions are pre-screened. He knew he was going to get asked that.
Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
That's this question.
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long bond rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant?
In other words, December cut.
Now?
You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall, feeling good about economic activity. So I think we would factor that in. At the same time, We got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
That's the National Income and Product Accounts revisions.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point? Or
25.
Shifted? And if it shifted at all, can you give a little bit of detail as to why?
I can't. We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December we're going to be, again, at every meeting we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? That we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. We're just going to have to see where the data lead us. We have, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say, I would say that, again, we didn't update the SEP, so I'm not going to characterize, where the committee would be.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress, and in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing.
Good call out.
Its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we net that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find that. To find the right pace and the right destination as we go, and I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Boring.
Steve Leachman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and is that are rising deficits a concern to you?
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outlines, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, you know, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you know, you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, you know, we have a very large economy. Many things are affecting it at any given time, and you know, a law change of some kind would go in there, but it would go in. But it would, you know, it's a process that takes some time. Clearly, the legislative process takes a lot of time, and of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And you know, the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But you know, right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of, you know, when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against, in that they go against the direction of policy by being adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
Yep.
I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, you know, 3 weeks later the 10-year was 50 basis points lower. So you know, it's material changes in financial conditions that last, that are persistent, that really matter, and we don't know that about these. What we've seen so far, you know, we're watching it, we're reading, you know, we're doing the decompositions and reading others, but right now, it's not a major factor in how we're thinking about things.
That's fair. Short-term noise.
Thank you, Chris Rugaber at Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop?
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate, and we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at the 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things.
I think that's bingo.
There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place. And our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. But we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Hi, Victoria Guida with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
I knew the question would come.
Can you follow up on?
And I knew he'd
do you
say
think
no.
that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television.
Look at it.
You talk a lot
Are you going to
about
quit? No.
what the data are telling you and how you are dependent on the data. But in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their world, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. people feel good about where the economy is. Demand is obviously pretty strong. And you're seeing, 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
To follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
Wow, it's so bullish.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is, to follow up on Victoria's question, do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney. Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk. And to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage. And so we're in the middle there. We try to be in the middle and deal with both of those, manage both of those. Again, the idea is to maintain, support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing where we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important, the precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of neutral, a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is. And we're going to move carefully as this goes on so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Urbanovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing between surveys and market readings broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's just not. It's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be and really have throughout this in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022 was to avoid that.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up. President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
So that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan.
It's back.
It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market. And we believe we can complete the inflation task while also keeping the labor market strong. And that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away. But that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
Last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime, so people have a chance to catch up?
He killed fate a long time ago.
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
Okay, summary time. There it is. I'm going to do a full summary here. If you haven't gotten the alpha alert yet, sign up. Go to meetkevin.com/alpha. It's totally free. Every morning at 6:15, try to get that out to you, and it'd be a little sort of thank you and provide some information and value back to everybody. Big fan of that. Okay, so what we're going to do is we're going to do a summary of everything we just heard from Powell Wowie, and kind of try to understand a little bit of, how to reconcile all of this, if you will. Okay, so let's get started. We also got bingo, so we'll talk about that. Okay, so let's go. There we go. All right, everyone ready? Well, this was probably the most bullish Jerome Powell I have ever seen, and ordinarily I would listen to this bullishness and say, LFG, let's go. But I have a weird feeling Jerome Powell was applying for his job here. Now, I know that might sound ridiculous. What do you mean, Kevin? He already has his job. Yes, but he was asked 3 times during the press conference, what would he do, or how would he feel, or would he basically quit if he's asked to step down, or how is he going to feel if he gets fired by Donald Trump? And it was so expected that he was going to get asked about it that we actually wrote it down on our bingo card. In fact, take a look at this. On our bingo card, which we got bingo, on our bingo card, we literally wrote down, are you going to quit? And then I wrote bonus, he says no. And he literally just said no and then went quiet to the point where the reporter's like, do you have any other comments on that? No. It was stone cold and great. But it showed you that, like, the idea of him getting fired was under his skin. So he's kind of like, okay, yeah, like, I know people are talking about this, so I'm going to come here and I'm going to be prepared to talk about it. That's, I think, what we got here. But at the same time, you also got a Powell who wanted to be in a position of, the economy's actually great. The economy's strong. This inflation is happening. And you know what? The weakness that you're seeing in the labor market, don't worry about that at all. That's just normalizing. It's just going back to its post-COVID normal. This was an interesting point of view from Powell, and it is one that makes sense. He recognizes that bond yields have gone up and suggests, hey, you know what? Bond yields went up when Bill Ackman shot them to 5% as well, and then 3 weeks later they plummeted. So who cares? Like, they go up and down, big deal, but we're not going to really take a few weeks of bond market movements and include that in our pricing. Our point of view is that there's no sign of inflation coming back. Inflation is going down. There's also nothing that we're worried about in the economy right now. Honestly, that was all pretty bullish. Like I said, it sounds like he's applying for his job, because if a president wants a bull, you got Jay Powell as your bull. He's like, hey, things are good. Nick T did not sit next to the New York Times girl, but he picks up on, hey, but, you're cutting rates and the financial markets are tightening. And he's like, fluctuations, economy strong. Maybe we'd be more concerned. But then we got really good positive revisions. He referred to the NIPO revisions again. The NIPO revisions are basically these consumer service or consumer spending and income numbers. And those revisions came out after the whole Jackson Hole panic, and they were pretty good. They suggested, hey, the consumer's saving more money than we had been thinking they were. We thought the savings rate had fallen under 3%, which is really bad and would be recessionary. And then all of a sudden, they revised them up to like 4.7% or something. Also very bullish. He also discusses this idea of, hey, we're in such a place where GDP grew in the third quarter at 2.8%. It grew at the same pace in the second quarter, and there are some murmurings that the economy in 2025 could actually be stronger, not weaker, which is really interesting, because at the same time as Powell is talking as bullishly as he is, the Treasury market saw a plummet in Treasury yields. You saw the 10-year come down 11.2 basis points. Here it is, 11.2 basis points down on the 10-year Treasury yield at the same time as Powell's talking about how strong the economy is. Why? Well, probably because the 10-year Treasury has been really concerned about inflation and sort of a new wave of inflation. And it seems like that concern over inflation has really gone away. At least in the minds of Powell and the board. Even though initially they suggested, we got rid of the phraseology that we're gaining greater confidence. He's basically saying, yeah, we got rid of that word because we're not gaining greater confidence. We are confident that we are on a sustainable path to 2%. And the labor market where it sits right now is fine. So if things go bad in one direction or the other, we can react to it. But he brought it up also like expected. He's asked about, hey, payroll job gains slowed to 104,000 on average per month over the last 3 months. I had been using 103,000. He rounded to 104,000. Fine, Powell. That's half the pace of what we had the first 6 months of the year. And his response to that is, but strikes and hurricanes affected this. Okay, I mean, that is the easy blow-off that most people were going with. So I think here you had this unanimous 25 basis point cut because board members were basically saying, hey, things are good right now. Let's just get to next month and let's see how next month goes. Because right now there's really nothing to say that things are falling apart. The data isn't unexplainably bad. Data overall and a stock market at all-time highs suggests things are okay. We also, and this is something I've been talking about for many, many months, is this idea about, hey, well, what about inflation? Like some of these inflation reports come in a little hotter than expected. And usually what I talk about in these inflation reports is, yes, but inside these inflation reports, when you actually decompose them, you find that most of the inflation is being driven by insurance, which is a lagging form of inflation, or the housing market, specifically owner's equivalent rents, which is also a lagging source of inflation. And the problem with that is when you're using lagging data to suggest, oh no, inflation side. No, not necessarily. It's definitely a possibility that inflation is coming down. But what happens is you have, as Powell called it, catch-up inflation, and this will skew some of the numbers. So catch-up inflation is basically saying, hey, all of a sudden we're in a place where, we think that inflation looks like it's going up on a month-over-month basis, but really, that's just insurance inflation or rental inflation from a year ago or 2 years ago. This is something that he made pretty clear as well. talked about a stronger September jobs report offset by a weaker October one, but then he balanced that and said, look, spending data's up and retail sales and inventories numbers are up, and we have better savings revisions. So, like, on balance, it seems like the data is roughly stronger, so we're just going to recalibrate, and we won't make any predictions in terms of what we're going to do with rates going forward. But even though the labor market's stabilized and continues to gradually cool, we're going to respond and hopefully keep it there by cutting rates a bit. He doesn't comment on the election, of course, as expected. He doesn't comment on this idea that we're going to, speculate on what Trump's policies, whether they're tax policies or tariff policies might be, because sort of as you would expect the Fed to say, they're going to wait to see how would this actually affect the economy and then make decisions around that, and then, of course, wait for data before reacting. So really, even though Powell says they can't rule anything out, this didn't, like, in other words, they can't rule out having an interest hike next year. They can't rule out pausing. They did say they would pause when they think they're closer to neutral. And they did say they'd cut faster if they had to, if the labor market started weakening. Really, there was nothing scary in this report. On balance, this report was really kind of like what you would want Powell to do. Show up, give us your 25 basis point cut, get us bingo on Meet Kevin's bingo board, and then go back home. Go back home and sit around for another 6 weeks until your next Fed meeting. This is highly expected. So now the questions and takeaways for this. Well, Powell basically poured cold water on the idea that inflation is reigniting. He also poured cold water, though, on the idea that the labor market is significantly deteriorating. So now all of a sudden, if you are a bear, okay, this is important. If you're a bear in the economy, you kind of have to look at this and you kind of have to say, all right, well, Powell does not see any weakening. Does he not see any weakening because he doesn't want to get fired? Does he not want to say that there's any weakening because if he does, then there will be weakening? Or is there truly no weakening? Like, it's somewhat hard to say. I think Jay Powell is generally an honest person, and I do think that the Federal Reserve, at least what they tell us via the Beige Book, does see signs of weakening. But Jerome Powell's calling this, quite frankly, normalization right now, probably because he wants his statue. He wants his Mount Rushmore statue of the Fed chairperson who actually stuck a soft landing and was the first chairperson to not cause a recession after a deeply inverted yield curve, a yield curve that's so deeply inverted that it would signal 500 basis points of cuts. And instead, he's slowly feeding us 25s in the hopes that we're going to be complacent and okay with that. As a bull, you want to eat up everything Powell just said. Because as a bull, you look at this and go, bro, he said, again, everything is fine. The economy's good. And actually, it is bullish by him saying this, because by him saying this, more people make bullish bets. More people, businesses maybe, might buy equipment, might hire people. Oh, okay, Powell says the economy's fine. People are going to believe him and they're going to react to it. Or at the very least, they're not going to react to the negative. If Powell came up and said, we have really big problems on the horizon, next year's going to suck, it's not going to be better, then you're going to self-fulfill that. So, all we can really say out of this one is, A, we got 25 as expected. B, we really got no forward guidance on what to expect. And while there were a lot of fluctuations, markets went into this expecting a 67% chance of a cut in December, and they went out of it expecting a 67% chance of a cut in December. So basically, Powell just survived the conversation, gave us the 25, going on vacation for the next 6 weeks. That's kind of what you got out of Powell here, which is good. That's ultimately what you would want, because, again, you don't want Powell to crash the economy, because that would self-fulfill a recession. Now, it is very interesting that Treasury yields did weaken pretty much everything that they gained after Donald Trump became president and was elected, became president-elect. Treasury yields were up somewhere around 11 basis points. Today, they're down 11 basis points. Part of this is probably Powell's confidence on the lack of inflation, which I completely agree with. And I also love his comment on, hey, you remember when the 10-year Treasury yield was like 5% when Bill Ackman was hawking it over here? He's like, 3 weeks later, it was down 50 basis points. I actually think there's a chance that Jerome Powell just gave you a clear as day signal to buy bonds, like hashtag TMF to the moon. No guarantees, like don't trade on that, it's just an idea. But it is interesting because Powell's trying to say, hey, economy's strong at the same time, and bond yields could plummet, but there's no inflation. So he's sending this, it sounds to me like he's actually not trying to send a clear signal to the stock market or to the economy. He's trying to send a clear signal to the bond market. We have inflation cured. Bond yields can go down. And if he's actually able to talk bond yields down, then what he does is he actually, again, increases the odds of a soft landing. So bullish TLT, bullish TMF after that, maybe? I mean, I'm biased on that. I'm exposed to those. But I think that that's interesting because, I mean, those were the words he said. Watch it yourself to see what he says. So anyway, that's my take on the Fed. Not much of a game changer here, but if you look for nuance, the bullishness probably should be taken with a grain of salt because of the weakness in the labor market. The, talking down yields going up should probably be a bit of an indicator that he'd like to see yields lower, but they ain't going to make any changes this meeting on it. So see what happens over the next 6 weeks. Anyway, those are my takes on the Fed. If you want my morning report on what's going on in the market, what catalysts to watch, and maybe how to trade certain things, hashtag not personalized advice, obviously, but it gives you a free report in the morning. Every morning at about 6:15 a.m., text it to you and email it to you. Send me a sign up. All you have to do is go to meetkevin.com/alpha, drop your info in there, and you'll be in, just so you can kind of see what that website looks like. It's right here. You can watch the video to learn more about what's in it. If you're outside the U.S., click here. Otherwise, you could click, if you're in the U.S., click the L button. And if you want a preview as to what a free one of those looks like to see if it's something for you, I'm still working on how to format it. But what you could do is you could go to ehack.com, scroll down past the Fed section, and once you get past the Fed section right here, for today, in case you didn't get the message, you could click on the Alpha report right here. When you click on that link, you'll see today's Alpha report and kind of what was in it from this morning. And you can see if it's worth signing up for you. So that's sort of a free way to look at it. And it's a free thing to sign up for anyway. So anyway, thank you so much. We'll see you in the next one. Really appreciate y'all. Goodbye, everyone. Good luck, and enjoy the rest of your trading day or whatever it is that you're doing. If you're in Ventura County, California, stay away from the fires. Thanks, folks. Goodbye, and good luck.